What is up, everybody? Welcome back to the Stock Trades YouTube channel. My name is Dan Kent, one of the co-founders of Stocktrades.ca, and in this video, I'm going to be doing something that I actually haven't done for a few years now, I think, and I'm going to take a stock that we highlighted and still do highlight over at Stocktrades Premium, and I'm going to go over it in depth. We highlighted this stock around 10 months ago, I believe, and it has been on an absolute tear ever since. I believe the market kind of misjudged this company based on the particular sector that it's in. It thought it would be overexposed to a particular subsegment of that sector, when in fact this company's revenues are protected by some very reliable clients, customers, and an overall industry that is not expected to be as cyclical as other companies inside of the sector. And that stock is Stella Jones. They trade under the ticker SJ.TO. It is a stock that I own, and it is a stock that, although it has gone up 70% over the last 10-12 months, I still do think that it is actually pretty cheap considering how much it is expected to grow moving forward, even with falling lumber prices. So in this video, I'm going to dive into our entire report over at Premium, including some discounted cash flow analysis, overall valuation. We're going to go over the risks of the company, the overall thesis, the company's recent earnings report, and just overall my thoughts as a shareholder of this company. So with that said, if you like these types of videos, make sure to head down below, smash that like button, drop a comment, and subscribe to the channel. And if you are interested in grabbing more of these reports, we have a 14-day no credit card required trial. We have, I believe, over 25 plus of these types of reports over at Premium. And that doesn't even include the model portfolios, the screening tools, the KPI segments, the live Discord, the Q&A, everything you can imagine. It is the most comprehensive platform out there, and you don't even have to enter payment details. 2 weeks to try it out, absolutely free, in the description below. But in terms of Stella Jones, let's get started with this company right now. So let's dive right into the report. Stella Jones, it trades under the ticker SJ.TO. We updated this on May 13th, 2023. We update these reports every single quarter. Every time a company reports earnings, typically we'll take a few days to digest the report, and then we'll put it out to Premium members. So I am long Stella Jones, like I said, and if we head down to a 5-year chart versus the TSX index, Stella Jones has underperformed the TSX over the last half decade. Now, there is a particular reason for this. Lumber prices had been extremely volatile during the pandemic, prior to the pandemic, and as a result, Stella Jones is cyclical to a point where it is going to rely on lumber prices, but it is structured a bit differently, which we'll get into in a bit here, that will make it more reliable despite falling prices. Now, this chart might not be telling the whole story over the long term, primarily because the TSX, especially in a post-pandemic environment, was fueled by rising oil prices. So at the end of 2021, in 2022, when inflation started, rearing its ugly head, Stella Jones had quite a dip here. We can see here that it, in early 2021, all the way till the midway point of 2022, the stock lost a ton of its value. I think it started trading in the low $30 range, maybe the mid $30 range. A lot of people were associating this company with falling lumber prices. They figured earnings were no doubt going to fall. The company was going to take a large hit. And a lot of people were making incorrect assumptions about Stella Jones, its overall revenue makeup, and the total impact, especially when it comes to residential lumber sales, housing starts, things like that the company would be exposed to. When overall, in reality, this company, relative to other lumber producers, has very little exposure to residential lumber sales. So obviously, when oil is rising and the price of lumber is falling, the TSX is going to outperform. It's got a ton of oil and gas stocks on it, while Stella Jones is going to underperform. But over the last year here, we can see that performance is quickly being erased. And obviously, it's fairly hard to predict price movements over the next year, 2 years or so, but I would be much more comfortable owning a lumber company like Stella Jones, especially with its product makeup, than I would an oil and gas producer, except maybe some best-in-class producers. I like this industry more than the oil and gas industry, and I do believe Stella is in a position to outperform moving forward. So, company description. Stella Jones produces and sells lumber and wood products. The company operates in two segments. Pressure-treated wood, which includes utility poles, railway ties, residential lumber, and industrial parts, and logs and lumber, which comprises of the sale of logs harvested in the course of the company's procurement process that is determined to be unsuitable for use as utility poles. It also includes the sale of excess lumber to local home building markets. So the vast majority of its revenue comes from its pressure-treated wood segment, and its geographical segments are in Canada and the United States, of which the majority of its revenue does come from the United States. So this is a Canadian company. It isn't traded south of the border. If you want to own Stella Jones in the United States, you would have to go to the OTC markets, but the vast majority of this company's revenue stream does come from the United States. So in terms of our growth score and our dividend safety score, it has a growth score of 2.7 out of 5. This has actually recently been upgraded. And I'll explain that in a few seconds here. Dividend safety score 4.1 out of 5, and I'll go over that as well. So it's in the basic material sector, lumber and wood products. We view the stock as a value and income option. Risk rating would be moderate. I'm not going to go too in depth on our risk rating. It's essentially a rating that we assign to a particular stock, mostly depending on the overall volatility of the stock and the sector it's in. So current price is around $59. I think it's dipped a bit off this, but it's really not too much. And 1-year price target is $69. Now that will be an analyst price target, and there has been some significant notable upgrades on Stella Jones over the last week or so that it's reported earnings, but this is not our target price. We do have discounted cash flow analysis, which I'll get to in a bit. This is analyst targets, not ours. So this will be a 12 to 18 month price target that they assign to the stock. So in terms of our growth score and our dividend safety scores, so these are metrics that we place on stocks depending on a multitude of situations. Their trailing valuations, forward valuations, their growth, their dividend growth, their current dividend yield, everything like that. So in order to break down these scores a little bit further, we can go to our stock screener over at Premium, and we can pretty much look up Stella Jones on our comparison tool to get a overlook as to why this company is rated so high. So we can see it has a market cap of about $3.4 billion, and the 14-day RSI at the time that I am filming this is 72. So this stock is overbought right now, and if you are a stickler for timing short-term price movements, maybe we would see a short-term pullback on Stella Jones just because of the pricing action coming out of earnings. It has gone up quite a bit. Beta of 0.72. This stock is less volatile than the market. So it is a stock that has pretty strong growth and is also a low beta stock, meaning it is not crazy volatile, which is a good thing. So Stocktrade's growth score is 3.3. You'll notice in the report it was a 2.7. That is because over the last week or so, it's had some notable analyst upgrades in terms of forward growth estimates, which has caused this growth score to increase. So dividend safety score of 4.1, we'll get to that in a bit. Current price of $58.58 with a 1-year price target of $69. That leaves around 18% upside at the time of filming this. It trades at a forward price to earnings of only 12.6. It has a PEG ratio of 1.07. So this is comparing the stock's current price to its forward-looking estimates. Now, you optimally want to look for stocks with PEGs lower than 1, but stocks with PEGs around 1 are completely fine. There's nothing wrong with looking at companies with this type of ratio. Price to book of 2.21, price to sales of 1.17, and a price to free cash flow of 24.47. So the price to free cash flow is a bit high, but this is actually lower than historical averages for Stella Jones. So it's not that bad of a price to free cash flow ratio to pay for a company considering its revenue streams and how reliable they are, and we'll get to that in just a bit. So we go down to the debt to equity of 0.6. This company has done a very good job creating shareholder equity with the debt it is using, and interest coverage ratios are nearly 11, meaning this company has a ton of capital to pay the interest owing on its debt. 11x interest coverage ratio is a very strong ratio. We look to profitability return ratios, return on equity, assets, invested capital, and profit margins, and we can see that every single one of these ratios is trending above its 5-year average. Profit margins 7.9 versus 7.8, return on equity 16% versus 14.5, invested capital 10.3 versus 10. This is a company that is seeing these ratios increase relative to its 5-year averages, which is always a good thing and a good sign. So in terms of growth, earnings streak of 4. This means that it's grown its earnings per share for 4 consecutive years. And we look to revenue, 19 years. This company has never had a year of declining revenue since, what would that be, 2004? Around 19 years, almost 2 decades. So we looked at 3-year and 5-year revenue growth. We're seeing double digits on average. Earnings growth, 18% annualized over the last 3 years, 10% over the last 5 years. EBITDA growth, 13% over the last 3 and 5 years. And when we look to forward-looking estimates, analysts predict that this company will grow earnings at around a 9.1% pace over the next year and revenue at around a 6.25% pace over the next year. And I'll get into why earnings is expected to grow faster than revenue when we look into the company's recent quarterly earnings report. So we can see that these earnings estimates for next year are lower than its 3-year and 5-year averages, and this is fairly appropriate. Lumber has taken a big dive in price, and although Stella Jones has lower exposure to the more cyclical segments of that, it's still exposed to the price of lumber, and it is still going to be impacted a bit. So in terms of the dividend, it pays a quarterly dividend. Yield is not that high, but again, don't focus on yield. People need to stop doing this. There are a ton of high quality companies that do not yield very much because their price appreciates with this. Don't get caught up in chasing high yielding, poor quality companies. We can see payout ratio 20% of earnings, around 36% of free cash flows, and it has grown the dividend for 18 straight years and double digit dividend growth, 5-year and 1-year dividend growth. Now, will dividend growth slow down? It's very possible depending on the company, how it views the future outlook for its utility pole segment, power pole segment, residential lumber sales. It might slow down this dividend growth, but it's really shown no signs of that currently. It is still growing the dividend at a pretty strong pace. So going back to the report, the pros. Although the value gap is closed, we're confident the company will outpace the markets. The company has an 18-year dividend growth streak. The dividend makes up only 20% of earnings. Although cyclical, it has consistently outperformed the TSX long term. When we look to its long-term price here, we can see that although in that report I did show you that it has underperformed the TSX over the short term, when we extend this out, total returns over the long term, Stella Jones, although it is cyclical, has outperformed the TSX by a pretty wide margin. And it historically has over the long term. We can see here that the only time it really underperformed was the short-term period when lumber took a big dive. And now that it has recovered, it's back to nearly doubling the pace of the TSX index. And when we look to annualized returns, it's put up 11.6% annualized returns. That is a very strong return from a lumber company. Only 20% of its revenue is residential lumber, and 65% of its revenue is from railway ties and utility poles. These are not going to be as cyclical as residential lumber, and that is one of the key things when it comes to Stella Jones. You look at companies like West Fraser Timber, they rely a ton on residential lumber sales, and as a result, stock prices have tanked. Earnings are expected to fall. This is why we see forward price to earnings ratios way higher than trailing price to earnings ratios, whereas Stella Jones is still expected to grow revenue and earnings in the future, and that is primarily because of its exposure to railway ties and utility poles. And when we get into the quarterly report of Stella Jones, we're going to see why it's driving really strong earnings growth and revenue growth. And it's because of these two segments. So the company is currently passing on costs due to inflation efficiently. It's raising prices and there's still a ton of growth. Again, we'll get to that in the quarterly report. And as of the most recent quarter, it's looking like it's going to exceed guidance on multiple fronts. So the cons, obviously there is negatives to owning Stella. We like to highlight both. Lumber prices continue to be volatile. Although it's negotiating higher price points because of inflation and supply chains, there will be delays in the results of these negotiations, which could ultimately weigh on the results. It hasn't yet, but they could. And as I mentioned, because of falling lumber prices, we're unlikely to see 20% dividend growth maintained. So the overall thesis with Stella, we believe Stella Jones presents a reasonably strong play from a value and dividend growth perspective. The company has finally broken out of a year-long downtrend in price, and we fully expect that it will grow faster than management is currently projecting. In fact, the company stated in its first quarter of 2023 that it was on track to meet or exceed guidance on multiple fronts. So of note, we speak more on this in the valuation section of the report, how buying a fair valued company is certainly not a bad idea. We don't constantly need to be chasing bargains. So the company's exposure to products like railway ties and utility poles that would be in high demand as long as infrastructure continues to expand will help reduce the cyclical nature of the lumber business. This is precisely why a company like Stella Jones has been able to grow its top line for 18 consecutive years. So the next closest in the lumber industry is Canfor Corporation at only 2 straight years. Nobody in this industry has been able to grow revenue like Stella Jones, especially with a near 2-decade growth streak in terms of revenue. The company is one of the only lumber companies in Canada expected to grow earnings and revenue into next year and boasts industry-leading profit margins over the long term. In fact, they're increasing, and I'll get to that in a bit. The company is not flashy, and we wouldn't expect any significant outsized growth. However, in the current environment, grabbing a company with a reasonable margin of safety and strong performance history is one we feel would be a long-term winner. So, potential risks. There is always potential risks in an investment. We discuss them in every single report we have. And when it comes to Stella Jones, although the company does have a bit more diverse product base than any other lumber company, it is still exposed to the fluctuating price of lumber, much like an oil company is exposed to the fluctuating price of oil. So, the cost of lumber has fallen by 74% since March of 2022. This is a significant dip in prices and is no doubt going to impact the company moving forward. It's not surprising that many producers such as Stella, Canfor, Western Forest Products, and Interfor are also down. Now, more of them, as I mentioned, are getting hammered because of their exposure to residential lumber, housing starts, things like that. But Stella is still no doubt impacted. Though it's a smaller chunk of revenue, a slowdown in housing starts will ultimately impact the top and bottom lines for Stella Jones. New houses cause a significant demand for lumber. If the housing market cools, so will the price of lumber and ultimately sales. The company's utility pole and railway division are also exposed to infrastructure expansion. If the economy were to slow and customers were to curb spending amidst higher interest rates, there is potential that the business could slow on that end as well. It isn't right now, but there is no doubt that it could certainly slow. And the company's rising debt and acquisition strategy also pose heightened risks moving forward in a rising interest rate environment. So, with a debt-to-equity ratio of only 0.6, the company has executed well in generating shareholder equity over the years to justify the debt. However, this could change due to the interest rate environment moving forward. So we go down to valuation. And as mentioned right now, we can see on a price to earnings, sales, book, and free cash flow basis that this company has virtually erase the value gap in terms of historical averages. But again, there's the old Buffett saying that goes, it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. In my opinion, Stella Jones is a quality company, and I really don't think paying fair valuations for it right now is that bad of an idea. So it has a PEG ratio of 0.89, and previously in the video I had shown that it had a PEG of 1.07, and the 0.89 in this report is highly likely due to the fact that forward estimates had been upgraded. So this is likely reflected in our report over our screener. So As we've discussed, Stella has all but erased a big valuation gap that previously existed. The company is up 22% in 2023 at the time of this update and 70% over the last year. However, despite these higher prices, we still feel it provides value. So it's trading at 14.97 times earnings, and on a forward basis, that drops to 11.77 as the company is expected to deliver strong growth this coming year. When we look to the company from a discounted cash flow perspective, if we take the company's guidance of mid-single digit growth over the next 4 years and we enter the following data, required rate of return is 6.7%. This is their current weighted average cost of capital. We look at a perpetual growth rate of around 2.5%. and shares outstanding of 58 million. This indicates a 7% buyback over that time period, consistent with historical numbers. And we pick EBIT margins of around 11.5%, which is their historical averages, although those are trending up as well. With this information, we reach a fair value of around $68. So when we first added Stella Jones to our list over at Stocktrades, it was trading at 36%, and we said that it had around a 20% margin of safety. At this time of update, considering the company's outstanding performance, the value gap has somewhat returned, although not in its entirety. If we hit a fair value of $68, we're looking at a margin of safety of around 15%. Now, in terms of this DCF analysis in the report, we do like to keep things very clean and not very convoluted. A lot of our members just like to see the end results. I have no problem answering more questions on this DCF analysis. Just grab a free trial of Premium, 14 days, no questions asked, pop in the Discord, and I will give you some more details on this analysis. We don't like to overcumber members and give them analysis paralysis. We keep it very simple, very clean, and if they want to ask more questions, they certainly can. During our last update of this report, you wouldn't have seen this, but we update these every single quarter. When asked if we would still buy Stella Jones at the higher valuation it had, we said yes. If operational performance continues, dividend increases, company guidance, and share buybacks will likely be higher than expected. In this case, its fair value is probably higher than the price it's trading at now. And pretty much every single one of these events occurred. It outperformed its guidance, it increased its dividend, its share buybacks came in higher than expected. It did absolutely everything right over the last year or so, and Stella Jones has really performed well. So looking at competitors, I have other lumber companies on here, but it's important to understand that Stella really has no publicly listed competition. While there are many competitors in the residential lumber segment, most of its revenue comes from utility poles and railway ties, both of which have no real competition, at least publicly traded companies. So this gives Stella Jones a bit of an economic moat as well, a very underrated one, as typically it gets lumped in with these other lumber producers. This is one of the reasons we like the company. It has a moat in this respect, which plays a significant factor in it being potentially less volatile. It is also why Stella Jones has historically traded at a considerable premium to others in the lumber industry. I mean, when we look at these valuations, 15 times earnings, we have 8.5 and 7.1 price to sales. Very big premium, price to book, very big premium, and price to free cash flow, huge premium. So again, in terms of competition, Stella Jones' moat in the railway business and the utility pole business causes it to trade at a premium valuation because of that moat. So dividend, won't go too deep on the dividend just because I did prior. So it is the only company in the lumberwood industry to achieve consistent dividend growth. The company owns an 18-year dividend growth streak, which is good enough to rank it in the top 25 among all TSX listed companies. So this is pretty big testament for a company that's revenue is generated in such a volatile industry. It only yields around 1.5%, but again, stop focusing on yield. Stop chasing those high-yielding, low-quality companies. A company that is low-yielding, that is growing the dividend at the pace that Stella Jones is, and its share price appreciating at the pace that Stella Jones is, you need to look at it from an overall return perspective. And in this regard, Stella Jones has done very well. Over the past few years, the company has grown the dividends in the low teens, and last year's raise came in at 3 cents per share, which equals out to 15% growth. So last but not least, the company's recent earnings report. So this chart here is looking at earnings estimates over the next years. This is not our analysis, this is analyst estimates, and these were notably upgraded in the last quarter. Earnings in 2023 prior to its most recent quarter were expected to come in at around $4 per share. This has been upgraded to around $4.60, so a pretty notable double-digit upgrade. Same with 2024 and 2025. And we can see that revenue is pretty much expected to be relatively flat over this time period. And the reason for this is the company is continuing to expand its margins. And obviously, when you expand margins, you don't need to grow revenue as much to get that earnings generation. So EBITDA low single digit EBITDA growth and EBITDA margins, they estimate that they'll stay relatively flat, but the company is making some pretty notable increases to these margins, which we'll talk about in a sec. So once again, Stella's annual estimates in terms of earnings and revenue in the chart above have been upgraded in a big way. 2024 earnings were increased by nearly 10%. So in terms of the first quarter of 2023, Stella topped estimates on all fronts and by wide margins. Earnings of $1.03 per share topped expectations of just 78 cents, and revenue of $710 million came in higher than the $706 million expected. EBITDA of $120 million topped estimates of $97 million. So virtually on all fronts besides revenue, which obviously is probably the least important one, we want to see that EBITDA growth and that earnings growth. It crushed estimates by quite a wide margin. So the company has repurchased 7% of its total shares over the last year. Now, will this slow? I think it will, and for a few reasons. The stock was so cheap over the last year that Stella Jones likely found it more viable to buy back shares at this price. It's likely going to slow these buybacks as the company is approaching more fair value, and it might transition this capital into acquisitions, heightened dividend growth. It will still continue to buy back shares, but I don't think that it will buy them back at this pace. So as mentioned, the company has reported that it is either on track or expected to exceed its guidance regarding revenue, EBITDA margins, debt to EBITDA, and its overall exposure to residential lumber. So let's zoom in on this image here a bit. We can see sales, they're expected to come in the $2.7 to $3 billion range. Its target is met or exceeded. So residential lumber, 20 to 25% of sales it wanted to hit over the last year. It got to 22%, so it met that margin. So it wanted its EBITDA margins in the 15% range, greater than 15%. It hit 15.4%. So it wanted its net debt to EBITDA to be 2 to 2.5x, and it has hit 2.8x. So it has exceeded that target as well. So when we look at the quarter strictly from a margin basis, year-over-year gross profit margins, EBITDA margins, and operating margins have all improved significantly in the 300 basis point range. So when we go to the quarter here, we can see that the company's gross profit margin rose from 15.4% to 19.2%. We can see its EBITDA margins went from 13.5% to 16.9%, and we can see that its operating income margin went from 10.3% to 13.4%. What is the impact of this margin growth? And it's fairly simple to understand when we look at this financial report, this quarterly report. We can see Q1 2023 revenue of $710 million. And when we look to Q1 2022, we can see $651 million. Not running the exact numbers, this looks to be around 9 to 10% growth over the last year. So it's growing revenue, at a high single digit pace. But when we come down to this net income, we can see $46 million last year versus $60 million this year. This is big growth in terms of net income. When we look quick glance, $46 million. So we're looking at $14 million in overall growth. Compare that to the $46 million it grew last year, and you're looking at overall growth of 30 to 33%. So the company has grown revenue by 9%, but earnings by 33%. It's not all because of this margin expansion, but as you can see, as margins grow, earnings tend to grow even when revenue doesn't grow at that fast of a clip. And when we look to earnings per share, they've actually grown earnings per share by 41% over the last year. And when you're looking at net income, it's grown around 30%. You're looking at earnings per share. This is the result of these buybacks. We can see that it has gone from 63.27 million in shares outstanding last year to around 58.8 this year. So here we can definitely see the significant benefits of share buybacks, especially when a company is buying back shares at cheap prices, which Stella has been doing over the last year. So back to the report, the company is reporting increased margins solely off pricing expansion, meaning that despite the fact it is raising prices on its utility poles and railroad ties, demand remains strong. This is a good sign. So the company witnessed strong growth, particularly in its utility poles category, which saw a 29% increase in organic sales. Overall, utility poles made up just over half the company's sales in the quarter. Railway ties also saw strong growth of 5% year over year and made up 27% of the business. So you're looking at, 77% plus of this company that is involved in railroad ties and utility poles. So obviously residential lumber sales decreased by 33%. This is not that surprising, as not only have housing sales dipped, but the price of residential lumber has collapsed over the last year. Because this segment makes up only 13% of the company's overall revenue on the quarter, this really is not that big of a deal. It still is a slight impact to the company, but 77% of the company's business has been in areas that are still growing despite collapsing lumber prices. So as mentioned, the growth from the other two segments offset the decline in residential lumber sales by nearly double. So overall, great quarter for Stella Jones. I really like this company. It's a stock that we've highlighted over at Premium for nearly a year now. I own the company. It's in a bunch of our model portfolios. You're not getting a super deal here, but again, buying a wonderful company at a fair price is better than a fair company at a wonderful price. I find a lot of investors try to bargain bin shop for a lot of their stocks. They're always trying to buy value at all times, when in reality, you could just be buying high quality companies at decent prices that are expected to drive strong growth in the future. Overall, when we research a company like Stella, we go a lot more in depth than is in these reports, but we do like to simplify these reports for those who might not want to take the deepest dive into the companies, but definitely want our commentary on them. From there, you can come into the Discord, you can hop on the Q&A on Premium, ask us a bunch of questions, any questions you want on Stella Jones. Happy to go even further in depth on the company. You just need to ask. And again, no credit card, free trial of Stocktrades Premium in the description below. If you like this video, it is very, very, very important that you head down below, smash the like button, subscribe to the channel, and drop a comment letting me know if you liked this type of video. I have no problem doing deep dives on companies, but I need to know if you guys like it. I need to know if you like it. I don't want to make these videos and have a muted reaction to them. With all that said, I will see you next time with more great Canadian investment content.